then, I can understand paying the $170 a share. And so here's where the contrasting opinions start coming in on the valuation of Tesla. Monday's going to bring in some interesting opportunities as we kick off a new week of earnings. And I got to be honest, there are some interesting companies that are going to be reporting. Companies where, I think valuations are a little bit questionable. And we're going to get answers during these earnings. And what is the investor's appetite going to look like after these companies report? So we're going to touch on that in a little bit. But first and foremost, I do want to touch on Tesla's earnings just briefly here. Now, if you're new to the channel, I had a price target on Tesla last year around $100 to about $115 price target. And we could see that this stock was pushing over $400 a share, sold off nearly 70% and hit that price target. From there on, the stock has absolutely outperformed, going up over 150%. And so now the question is, with this recent volatility and now Tesla trading back down to $200 a share, where would I be looking to possibly be interested in this stock? And just so everybody knows, I don't follow every little thing Tesla does. I just review the numbers through a fundamental analysis and try to find opportunities that I feel like are disconnected. But before we get into Tesla's quarterly report, I do want to make a few things clear here. This company trades for a substantial multiple when we compare them to your traditional automotive companies. And I understand why. This is obviously a tech play along with automotive sales, but where they make the bulk of their revenue is going to be automotive sales. So you have to kind of meet in the middle here. And the one argument that was always had with Tesla is that they have the best margins and you have to pay a premium for that. But let's dive into their quarterly report, because I think the biggest question overall is not going to be, is this company profitable? Is this company going to be here? Does this company have a competitive advantage? I think the answer is yes to all those things. The question is going to become, at what multiple should we be putting on Tesla? And that's really up to the investor. And so my price target could be completely different than anybody else out there. So when we scroll through Tesla's earnings, we see a nice tick up here in cash equivalents, and short-term investments. As most of you know, you're getting over 5% in short-term treasuries, and Tesla's most likely taking advantage of this higher rate market, going to be earning a substantial amount of money on these short-term investments here, with over $10 billion in short-term investments. So we're seeing here in the 9 months ended of September 30, going from 2022 to 2023, there is some good top-line revenue growth here. And what I want to make clear is that this is a company trading for an extremely high valuation of 66 times earnings. And so when we understand that, that means that if earnings remain constant, it'll take over 66 years to get my initial investment back. And so when we have these high valuations, the only way we offset these valuations is with extremely high revenue growth. And while this revenue growth is impressive, it's not pushing over 40% revenue growth. And so it's still going to take a tremendous amount of time for you to invest in this company and get your initial investment back. So when we bring it down to a bottom line total automotive revenues, we have 20% revenue growth here, which is extremely strong. I'm not taking anything away from that. But I think the one thing I want to highlight is the growth in energy generation and storage. This seems to be a very fast aspect of their business model that is growing, and it's a nice complementary to their bottom line revenue growth here, which we want to keep in the back of our heads while we're doing the valuations. Now we're seeing a substantial dip in automotive leases, and so now here's where the problem's going to lie, and here's why we've been putting a high multiple on a company like Tesla, is their margin expansion that's supposed to be taking place. But we can see here that revenue is growing, but gross profits are shrinking. And this is a big red flag here, ladies and gentlemen, because now this is telling us that they possibly could be losing their competitive advantage. They're obviously economically sensitive to what's going on here. And the other thing I want to highlight is inventory levels are ticking up. And so is this something that they're planning for? Is this, are they going to have to sell more cars for discounts because inventory is getting bloated? So something just to keep an eye on. As I stated, I'm not following every single thing that Tesla does, but I am starting to dig into their quarterly report and build a thesis here. So we're seeing a tick up in SG&A. And when we see a tick up in SG&A, that usually means that companies are losing competitive advantages. If we see that go down, that usually means they're gaining a competitive advantage. They're doing something better than their peers. And as we see here, this is something I want to highlight, that they could be losing some sort of advantages. Without even putting in any numbers right now, a couple things I want to talk about. Number one is revenue's growing, but probably not as fast as it's demanding for the multiple that it's getting. Number two, gross margins are absolutely collapsing. This could be a very, very big problem. Number 3, total operating expenses are going up, with SG&A being a big bump, meaning that they could be losing a competitive advantage. This is not me being a bull. This is not me being a bear. This is me just going over the information. When we take a look at earnings per share, how long is it going to take for me to get my investment back? We can see that EPS is actually shrinking here. There are now more shares on the market. There is some dilution here. Not a lot, but something we have to account for. And when we look at the net income, once again, shrinking, and where it's getting more concerning, net income for the quarter is down 40% from the year prior. This is a big, big red flag. There's a lot of red flags in this report, and I understand that this is a very innovative company. I understand everything behind it, but taking my emotions out, not being a bull, not being a bear, this is very, very rich valuation, and it's actually a richer valuation overall compared to where it was trading last year, even though the stock was probably more expensive, because you were getting more earnings per share and the margins were stronger and the growth rates were projected to be higher. So therefore, at that point in time, it was probably a cheaper stock than it is today. When we kind of look at the sentiment of the stock, we have price targets as low as $85 and as high as $380. And when we go to stock analysis and get a 2023 projected full year revenue, we get $100 billion. In 2024, we get 124. So I'm going to err on a little bit of caution here. I'm going to say by 2024, they're going to do right around $120 billion of revenue. Currently, right now, they're doing right around $73 billion of revenue. By the end of 2023, I'm going to err on caution, say they do right around $99 billion of revenue. By 2024, they're going to do $118 billion of revenue. By 2025, they're going to do 136, and so on and so forth. Still keeping growth rates fairly elevated here at 20%, 15%, and 5%. Now, the question becomes, can they regain margin expansion? Can they get back to normal margins? And that's going to be a big, big question here. Historically, they've shown us that EBITDA margins were expanding, but over the last 4 to 6 quarters, we're starting to see margins compress here. And so I'm going to err on caution and say that they're going to do around 18% EBITDA margins. So when we look at a multiple of enterprise value to EBITDA, we can see that Tesla trades for an extreme valuation compared to their legacy auto brands here, 38 times to roughly 8 to 10 times. And so I want to show you guys what that looks like here. And so if we were just looking at Tesla as just an automotive company that was probably growing around 4 or 5%, we'd probably be looking at closer to a $50 to $60 stock. Tesla's like an AI play with automotive and energy. Then, I can understand paying the $170 a share. And so here's where the contrasting opinions start coming in on the valuation of Tesla. Now, me personally, I definitely think there's some truth in the middle of all of this. I think they're probably one of the most innovative companies out there. I think they still have a tremendous amount of growth opportunities in front of them. I also think margins are a problem. I think there's a lot of red flags that I read through this quarterly report. And so where I think the multiple makes sense is definitely somewhere in the middle of legacy automotive and where they're currently trading. And I would say putting a 25 multiple on Tesla makes a tremendous amount of sense. And we still arrive basically at that 115 mark. That could get changed really, really quick depending on what kind of multiples the market wants to put on it and how investors really value the company. And so this is where the art investing really, really comes into play here, because there's many, many ways we can really look at this company. And so some of the earnings that are coming out are going to be pretty interesting here, highlighting CVS, as this is one I've talked about. When we look at the type of revenue this company's doing or projected to do, right around $88 billion of revenue, earning about $2 a share. Company's trading right around $65, $66 a share. And is growing right around that 7 to 10% mark, sitting right around 8.7 is what the street's projecting out. This company trades at a single PE ratio. It definitely has some concerns, but nothing to do fundamentally with the company today. All the concerns that are being built up for this company are things like Amazon getting into the pharmaceutical aspect of healthcare. And so this is where, once again, we have to weigh out, is this a value trap? Is this a value play? How much of a market share can Amazon take away? What kind of competitive advantage does CVS have in order to sustain EPS growth, revenue growth, and still be a substantial business and a substantial investment for most people? And they return capital multiple ways. They buy back stock. They pay nearly a 3.5% dividend. And everything that this company does is what you look for in a long-term investment here. They're growing, they're making mergers and acquisitions, they're returning capital to shareholders. And so the biggest question is the future of the company. And that's where it gets really, really hard to tell, is Amazon going to monopolize here? Is the government going to allow Amazon to monopolize? And so using very, very growth rates of 4%, 2%, and 2%, I basically get a fair market value between $56 to $65 on the stock, and it is absolutely trading in that range. Look at the possible price target in 2031 of being $145 a share with a 3.5% dividend reinvestment. That is a very, very nice rate of return. That could absolutely beat the market. The question with the company is not the fundamentals today and not the fundamentals for next year, but the fundamentals over the next 3 to 5 years. And so that's where it gets a little concerning, but I think they're well diversified. I think they've done tremendous mergers and acquisitions that their CVS brand could kind of die out here, and still revenue growth will be strong and still free cash flow will be strong. But of course, this is just my opinion. You always have to do your due diligence. But this is a company I'm very, very interested to see report earnings, because the last time they reported earnings, their stock shot up around 10%. And with the recent sell-off, I think it could do it possibly again. If anybody's watched my videos, I don't need to talk about PayPal. You guys know my price target. It's around $50 to $55 a share, currently sitting at $50.50 roughly. Street is expecting 2.4% growth. This is a company that's basically trading in almost a single-digit PE ratio, and they really need to beat this in order to get out of this massive downtrend, trading from roughly $100 a share down to $50 a share. This company has fallen off of a cliff, and the only way they can save themselves is with strong growths and strong earnings. So we will see what happens with PayPal, and we'll see if a $50 valuation even makes sense after the earnings. Now here is the doozy, ladies and gentlemen. The love and the hate that we see for Palantir and for Tesla. To me, these are very, very similar stocks in a lot of ways here. When Tesla was blowing up, a lot of the expectation was built on hope, and that hope did come to fruition in a lot of ways. Hope that the growth rates can maintain strong levels, hope that they can take away market share, hope that they can keep margin expansion, and all those things kind of happened under Elon Musk's management. And people were rewarded for that. And a lot of fundamental investors probably stayed away because the numbers were pretty astronomical. I think the same thing can kind of be said for Palantir, a company that's been around for a really long time, very integrated into the government side of business. I hear about all these contracts and we hear about all the innovation, but the problem I have is the company's growth rate has drastically slowed. And that makes me scratch my head a little bit here, because if they're so innovative and they're getting all these contracts, why is it not coming in on the top line? And this company is not like it's been around for only 4 or 5 years. This company's been around for a significant amount of time. And so where all this contract money, where's all this money going? And when we look at their revenue and what their valuation is and how much is actually going down to bottom line and how much is actually coming in through operating income, it's a really head scratcher for me on the valuation side of things. And I did have a price target, which it did hit the price target I was looking for, between $6 and $7. Maybe in the next 12 months, this company's pushing $3 billion of revenue, earning 10-15 cents a share. For the valuation that you're paying on the company seems pretty rich in my opinion, but who knows, maybe earnings can absolutely get us back on track to get a higher valuation for the company, because where the company stands right now, was trading as high as $20 a share recently. For me, I still look at this as basically your $6 to $7 stock. And if it got back to those levels, definitely be interested once again. But I also want to see some progression on the balance sheet. I want to see some progression on their quarterly reports and earnings. So as always, guys, hopefully everybody enjoyed that, and we will see you in the next one.